5 mistakes that the IRS hopes you make. And the reason that they hope you make these mistakes is because if you make a mistake and they catch you, they get you with penalties. Not only penalties, but interest. And the interest rate is super high right now. And you might end up owing double. The first one is not reporting all your income. Most people think that you only have to report the income that you get from your 1099s, but that's not true. If you make money from anywhere, the IRS wants you to report it. And remember, if you get audited, they go through your bank statements. They now go through your Venmo. They try to check your Zelle account. They go through your Cash App. The IRS is trying to get all that stuff reported. So remember, if you don't report your income, the IRS is going to get you. Second mistake that the IRS hopes you make is taking deductions of normal things you know you shouldn't deduct. People try to deduct their haircut. They try to deduct their watches. They try to deduct their suits, their shoes, their clothing, their makeup. Unless you're in motion picture and television, all that stuff is a negative. The IRS is always looking for that stuff. When I used to work at the IRS, if I saw something from Rolex, you better believe that I would start looking for even more things you weren't supposed to deduct. So be careful, don't make that mistake. The third mistake that people are trying to make is claiming dependents that don't depend on you. Now, in order for you to claim a dependent, that's usually a child, a parent, a grandparent, a niece, a nephew, even foster people that you foster, claiming them, they need to depend on you for over 50% of their living. Not only that, is most of them need to live with you 50% of the time, except for parents. Parents can live in their own house, but if you are paying for over 50% of their living, then you can claim them as a dependent. And remember, if you're single and you claim a dependent, you can claim someone in a special tax bracket category as head of household, which means somebody depends on you and you're single. And that gives you preferential treatment regarding your tax brackets, and you ultimately pay less tax. The fourth mistake that the IRS is always looking for is using your car as a tax-free ride. Remember, if you want to deduct your car, you have to use it for business. And it's really important that you don't try to deduct the entire automobile. Because when I worked at the IRS and I was auditing people, I'd always look at their automobile and whether or not they put 100% for the deduction. I know, and you know, that you use your car for more than just your business. Unless you have a fleet of cars, you know that you're using that car to take your kids somewhere, to go to the grocery store. Now, you may very well be using that car for 60, 70, even 80% business. But be careful, because the IRS is always looking for the automobile deduction and to see if you're abusing it. The fifth mistake that the IRS is looking at is whether or not you're deducting entertainment. Now, many years ago, you were able to deduct both meals and entertainment, at least half of it. But now you can deduct half of your meals, but none of your entertainment costs anymore. And that means that if you're using entertainment to prospect clients, it's no longer deductible. That means if you're buying tickets to take them to the Vegas Knights, you're taking them to the Raiders, you're taking them to some show, you are not allowed to deduct the cost of the entertainment. You are allowed to deduct the meals during that entertainment event. The only time that you can now deduct entertainment is if you're throwing a big entertainment event for your employees. In that case, it's an employee benefit, like a holiday party. In that case, you can deduct the entertainment. But if you're using it to prospect clients, you're no longer allowed to do that. If you like what you learned today, follow me or my website, taxstride.com, for more tips to keep the IRS off your back.